What's up, guys? It is Friday the 26th, coming into the end of a quarter, the end of a month. It's always the tough times, man. I got all kinds of folks needing us to get certain things done for that quarter. And it's just a tough angle to have to work when you consider everything we've been talking about this last little bit. So since the last time I had Mr. Scotty Bear on here, we got ridiculous reception. Scott has an argument that has to do with the topic. I'm thinking that could be the sexiness of Scotty Bear. We'll let you guys decide. What's up, Scotty?
How you doing today?
We're going to find out. I'm going to find out. You're talking about, a Friday in this particular environment. It could be either be really, really simple, or it could be one hell of a shitstorm. Well, that's what we've experienced at least this last week, right?
Last couple weeks, shitstorm.
Yep. So, a year ago, we were going through some pretty rough stuff. I didn't have a Scotty Bear aboard, so I was having to slug that out solo. And I have no idea how we accomplished what we accomplished back then, because having Scotty now makes all the difference in the world. For those of you who have heard from him, he's talked to you about what's going on with rates and what to expect just for the short window of time we know. And our window of time is what can be as long as 20 minutes sometimes, and that's it. The window closes and we gotta get more data.
Used to be when I had a conversation with a borrower, we discussed rate, we'd agree, we'd hang up the phone, and we'd be done, they could move on the merry way, and I would lock their loan. Now I encourage borrowers to stay on the phone with me while I lock rate, because in the middle of locks, it's not uncommon that we get rate changes without notice. So I can be in the middle of a lock and it pops up on the screen, you need to go back. Rates have changed, sometimes for the better, but lately it always seems like for the worse.
Yeah, I think things favor the worse than it does the better in our current environment. So another thing that's a little different, I'm out of uniform. I got a friend of mine, Mr. Clint Compton, came by the other night and dropped this hat off for me. So I'm going with a little bit more cleaner approach. This would be for black tie events. I'm thinking I'll still wear the other for the black tie event. There's nothing better than somebody showing up with camo on their head and a nice suit, right? So if you want to know who Clint Compton is, before we get into the depth of things, you want to head over to, I'll share a screen with you. You can head over to quitjerkingoff.com. That's where you're going to see the Quit Jerking Off initiative with my partners at SGOC Media here. This is Clint right over here. So he's showed up the other day to a meeting we were having about things we were doing, and I can't get this thing to scroll. So you guys can scroll around and take a look at the website. You can type in QJO Initiative.com or quitjerkingoff.com. Either one works. They'll take you to this site. You can check out the videos, check out what we've got going on with it. Subscribe. Definitely want you guys to go in and check out the videos, subscribe. A lot of the people you work with in the real estate investment world, they're all in here. We got videos with some really, really good people. And if I can get the damn thing to scroll, I would. Here we go. You can see us rock crawling, we get around the fire at night and have the deep conversation about what was the best thing they've ever experienced, worst thing they ever experienced, but ended up becoming the best thing. So check that out. Definitely worth your time. But let's get into what we've experienced this week. So one of the things I've had over the years is people do tend to, when they're I hate to say uneducated, but uneducated is the only way I can explain this. Uneducated about what really drives interest rates, they tend to go with looking at the Treasury, U.S. Treasury, look at the 10-year. What have you been seeing the 10-year doing lately, Scotty? Because I know you follow that.
The 10-year, in theory, or when Fannie and Freddie were taking pretty much all these loans, the 10-year as it rose would be worse for us for rates. 10-year, when it went down, was better for rates. An example, yesterday, I believe the 10-year went down and rates got worse at one point during the day. And today the 10-year is up, and I'm actually, the first loans I've been able to lock this morning are better rates. There's no rhyme or reason why rates are doing what they're doing, at least from the investor side.
Well, and it's no rhyme or reason when a person gets into the market, and as you just indicated, I had commented in the past about how there is sometimes a converse relationship, meaning an opposite relationship with the 10-year and mortgage-backed securities. And the reason even people go there and look at it from that respect is because The 10-year is a long-term bond, right? You put your money in there, it's going to pay out a flat rate of return over a specified period of time. Same thing on the mortgage-backed security. It's a long-term bond in a bond pool that's tied to and securitized by real estate and a person's ability to repay or promise to repay. That's where your note comes in, or your deed of trust and your deed of trust. So ultimately, that long-term bond is very, very similar to what the 10-year is, and people would follow that to see where's money going. Is it going into bonds or is it going into equities? It kind of gives you an idea where the general consensus is flowing capital. So when we look at the mortgage-backed securities, you would think, I mean, we've seen the swing we've seen from the lowest point, which would be the highest point on these charts. Highest point on this chart right here is showing 105.28. Right? Well, we're right now, as of today, we're sitting somewhere right around, well, I can't even see that. Let's see here. That would be 104.25. That's only 100 basis points, right? So if we were mid threes when we were closing back here, which we were when we were up at our highest point, we should say that our interest rate might be 100 basis points higher, which is the price, which is equivalent to maybe, what would you say, Scotty? Maybe 3/8%, maybe a half a point?
I would say 3/8, probably half max.
Somewhere in the range of about a 3.875 to 4%, comparatively speaking to what it was. But what type, and right now our common interest rates are the high fours. We're locking at 20% down, 30-year fixed, 740 plus credit score. So it's literally 200 or 2 points higher than well, it's a point higher than we think it should be based upon the charts. So since we have evidence here that what it should be based upon the market itself, there's got to be other dynamics involved here than just the market. So we get back into what we talked about last time we had Scotty on. We had that big emergency, the urgent, you got to watch this, right? You know, the Federal Reserve, or the US Treasury via the Federal Reserve, as we can tell, if you go even further back, I'll reshare this screen. They were basically the interest rate savior, if you will. Everybody was there at that point, seeing where all this benefit came and interest rates going down from a year ago. You know, so this is March 9th when everything hit and started to get all sideways. March 26th, this is about a year ago. Right here is right where the Fed started, right there, where the Fed started, was putting money back in, started the 20th of last year. $1 trillion went in, stocked by the 30th, and then they did a maintenance amount of anywhere from $4 to $10 billion a day. Because of all that money flowing in, interest rates reached an ungodly low number, right? So on one hand, the US Treasury through the Fed is basically the savior of interest rates, creating this ungodly low interest rate environment where we can enjoy something that's much lower than we've ever seen, right? We still were in those great rate ranges, even when we were at our lowest point, which is equivalent to where we are now. So there's no reason we shouldn't be there market if we were relying directly on the market. But then you have what we talked about last week. And I had mentioned in the past, in a lot of my videos, saying, I don't know what the end play is going to be for the Treasury to shove so much money into the mortgage-backed securities, because now they own the majority of those loans. They're the ones who put the money up, right? So the Treasury created the money, the Fed injected into the mortgage-backed securities pools. It's literally our capital, if you will. It's the US taxpayers' money that brought those interest rates down. Now that they control all of them, they sat down, Fannie and Freddie said, guess what? You're going to take 93% of everything you do has to be for owner occupancy, not investors, not second homes, meaning vacation properties. So now we have to find somebody else to pick those deals up. Somebody else has to purchase it. It's not Fannie and Freddie. They're out of the market for the time being because they exceeded that 7% already. What's crazy, it wasn't a thing where the Treasury said, starting today, you can only do 7%. No, they said, going back to the beginning of the year, we're going to say you have to keep it on average 7%. We're over 13 or 14 right now. So they're not a player right now. Because of that, we have to use what they call an aggregator, separate people creating different pools for us to be able to draw money from. And those different pools are what are funding this. And it depends upon their appetite. They don't have to buy it. Nobody has to buy it, but they do realize the value of the paper. Again, other of these videos that I've done in the past talk about how well these performed. We have better performance as far as lower ratio of late payments or delinquencies or defaults in the real estate investor, at least the ones that we do. I can't speak to anybody else that does this. So when they look at the history, this is good, clean, solid paper that performs. Therefore, we have sources. but there's only so many sources out there, right? And as a result of that, they're going to dictate what the rate is based upon their appetite for the paper and their demand. So what are we seeing today, Scotty? When you're running rates, are you seeing a very uniform scenario here, or is it change dependent upon, well, what things change? What are influencing it that you're seeing?
Everything changed. LTV, an 80% LTV. There was for the longest time, we always had 0 point options. Right now on investor properties, we're seeing pretty much no 0 point options on 80% LTV. 75% LTV, we're seeing 0 points, but not a big difference in rate. Again, going back in the 80s, I bought investment properties. I was at 13%. In 2001, I think I bought a primary residence. It was 8 or 9%. I have a current loan on one of my properties. It's 3.25%. You can't let rates scare you on these investment properties. It's just part of it's part of the transaction when you're purchasing properties. If as an investor, you're buying the property for the house and land that it sits on. You're not buying it because, or we hope you're not purchasing because we're at an all-time low on rates. And for those that want to kind of float and see what the market brings, again, are we at the historic lows that we were at, say, 60 days ago? No, we're not, but we're still 4.25, 4.75. Even if we get to 5.25, probably here in the near future, we're still at historic lows. The rates are what they are at the time that you're purchasing, and we get in these 30, 45-day windows to close. Truth be told, again, if rates even, who knows, at the end of this year approach, say 6%, it's not going to keep the investors on the sidelines. People are still going to be buying properties. 6%, it's just going to be the rate at the time they do that transaction. It's part of doing business. And for those that are locking at, say, 4.5 today, or whatever the rate may be, don't go in with the mindset that, well, I'll lock today at 4.5% and refinance, if rates drop again. You need to understand 4.5%, 5% are amazing rates. These are rates that you shouldn't be refinancing. The cost to get there, it's not worth it. Rates are part of the transaction. Lock it, don't look back, and just move forward to the next deal.
Exactly. And understand that there's a blessing in this going up. We had such enormous amount of demand coming in that is overwhelming all the systems, right? And as a result of that, it eventually had to push things up. And what it does is it gets people out of the deal that was only in there for the rate to begin with. Opportunivores, as I called them before, people that were investors because rates were so cheap. This needs to be a line of people that are investors because they're investors. And as Scotty said, even if it gets to 5.25, which it easily could in our current environment, we don't know where it's going to go. In fact, run your numbers with 5.25, 5.5. It's still a deal because it's 30-year fixed. We've talked about that over and over and over again. I'm going to share this chart again. Even if interest rates did go to 5.25, I'm going to change this date up here just so you guys don't get distracted by that. We're going to go with 4/1/2021. But at 5.25, you would pay on a $100,000 purchase with $80,000 loan amount, $441.76 a month. That means a total of $79,000 interest, $80,000 principal for $159,000. You're nearly double what you borrowed, right? So you borrowed 80, you pay $79,000 in interest. But because of the time value of money that we talked about, with inflation eroding the dollar, you're only paying right here $66,432 with that money as you pay it back slowly. Look at this, $441 a month. That principal and interest is worth year 30, $54.43. That's the erosion of the dollar. Go to shadowstats.com and look at this. If you do not have a subscription there, subscribe to it. Get to know that, understand it. It teaches you a lot about the real rate of inflation, not the bullshit inflation we've been being forced to understand. So having a 30-year fix is still a gift. A lot of people say, should I hold out and see if the rates go down? No. I don't know if the 30-year fix is going to go away. I can't say that it's going to stay forever. I can't see that it would go away, but I didn't see that the Fed was going to pull something. I knew there was something was going to happen. They weren't buying all these mortgage-backed securities for nothing. But what if they made that go away? Then you're super screwed. So take advantage of the fact we still have a 30-year fix. Use that 30-year fix. When you raise rents, it's going to offset the difference in the payment anyway. We'll talk about that next time. Next time, we'll talk about how much the payment went up with that little bit of bump in interest rate, and how many rent raises of 3% is all you got to see to be able to see how long it'll take to erode that so-called loss in your mind. It's not a loss, but let's go ahead and address it as you think it might be. See how long it takes before that's completely made up and you're back in the same cash flow you thought it would be. It's not about year one. It's about the long haul. Any final words for us, Scotty?
No, I mean, more than ever, everything's so sensitive. Credit score, huge impact these days, more so than ever to what rates are. 740 plus gives us usually best case scenario. Anything less, again, we're here to find the best deal possible, but help us, give us 740 plus to work with, and that's going to give us a best case scenario. If paying points is a killer to you, instead of putting 20% down, put 25. That usually gives us a no point scenario. But for myself, the eighth of a point or quarter of a point, it may save you in rate. I personally rather have the other 5% move it on to the next property and, pay a half a point or 1 point or, whatever the case scenario is that we pull up for you on that given day. Again, I can't say it enough. Don't let the rates scare you. Just, it's the cost of business today. Move forward to the next deal. Don't look back.
Yep. And I appreciate that, because he's 100% right. That and our price points are changing. What we can get funded nowadays, because of where things are going, has to go up a little higher. It can't be those lower 50s to avoid failing the low-income housing regulations for cost to loan size ratio analysis. Now you got to look at like maybe at $65,000 minimum loan size to avoid that particular problem. Credit scores, we used to be able to go down into the sixes. It's actually getting harder to do that now because of what that forces into the interest rates. So 700 credit score and higher is what we got to focus on. Just know there's going to be some nuances that we're going to have to adapt to, but adapt. The benefits are there. Adapt. So thank you, Scotty. Appreciate you being available, brother. And we'll come back around and see you guys here soon.
Catch you next time.